Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. On today's show, we're taking a deep dive into an issue that's quickly becoming one of the most critical factors in site selection, in underwriting, and property development across North America. It's the state of our electrical grid. If you've been reading the headlines, you've probably seen a lot of finger pointing. The mainstream narrative goes something like this. AI and hyperscale data centers are single-handedly overwhelming our power grid. They're driving up energy prices and threatening to break our infrastructure. But if you dig just one layer beneath the surface, you realize that AI is not the underlying cause of the crisis. It's simply the catalyst that exposed a multi-decade-long backlog of underinvestment. Today we're looking at the real drivers behind grid modernization and why public utilities commissions kept the system running on borrowed time and what this means for you as a real estate investor. To understand why billions of dollars in capital expenditures are suddenly flooding into grid modernization, we have to look back at how public utilities have operated for the past 40 years. Electric utilities enjoy something that's not part of normal everyday commerce, and that's a monopoly. In exchange for that monopoly, the prices they can charge, the revenue they can earn, the profit they can make is governed by the Public Utilities Commissions. These regulatory bodies are tasked with a primary legal mandate, and that's ensuring utility companies provide reliable service at just and reasonable rates. In practice, however, the political pressure heavily skews the definition of reasonable. Regulators face constant pressure from voters and local politicians to keep monthly utility bills as low as possible. When a utility company asks the Commission for permission to raise rates to replace aging transmission lines, to upgrade transformers, or harden substations, the regulator's default answer for decades was simple. Push it out in time. Cut the capital expenditure budget, defer the maintenance. This short-term bias was further enabled by a unique structural reality of the 2000s and the 2010s. U.S. demand for electricity was basically flat. Thanks to energy efficiency breakthroughs like LED lighting, high-efficiency HVAC equipment, overall electricity consumption grew at less than 0.5% a year for nearly 15 years. And you have to remember the U.S. population was growing during that time. Because the total demand wasn't growing, utilities and regulators convinced themselves that major structural investment wasn't urgent. That allowed the grid to operate past its intended design life. Today, more than 70% of North America's transmission lines and power transformers are over 30 years old. We've been driving an infrastructure vehicle well past its maintenance warranty, ignoring the check engine light and simply because the engine hasn't seized up yet. Now, all of those chickens are coming home to roost. What we're witnessing is a convergence of several non-discretionary forces all hitting obsolescence at the same time. First, you've got physical end-of-life replacement. Equipment is failing simply because of age. You can't push a 40-year-old transformer past its design limit without risking failure. Utilities are being forced to spend billions just to maintain baseline reliability. Second, we've got electrification. Both residential and commercial heating is rapidly shifting from natural gas to heat pumps. At the same time, the transition towards electric vehicles and corporate fleet charging is putting a tremendous amount of pressure on distribution circuits. Charging an EV fleet is not a minor increase. It doubles or triples peak load demands on local feeder lines designed back in the 1970s. Third, you've got clean energy integration. The legacy grid was built to send power one way, from the centralized power plants to the users in their homes. Today's grid has to handle complex bidirectional power flows from utility-scale solar, from wind, from commercial rooftop generation. That requires smart substations. It requires advanced metering and large-scale battery storage to balance the load. Fourth, you've got climate resilience and wildfire mitigation. Utilities in dry or storm-prone regions face existential legal liabilities if their equipment triggers a wildfire or fails during extreme weather. Billions are now being poured into underground power lines, installing covered conductors, and deploying sectionalized switching. And then fifth, on top of all of these structural pressures, you've got the demand from AI data centers. These high-density compute facilities require massive amounts of continuous power on timelines that grid operators simply can't accommodate using their traditional multi-year planning cycle. Now, fortunately, those hyperscale data centers have been given permission to generate their own power, so that's not necessarily going to put tremendous pressure on the grid, at least not directly. So what does this mean for us as real estate investors? It means the era of cheap power and guaranteed utility capacity is over. Utilities are going to spend hundreds of billions of dollars in the coming decade to modernize the grid. And because of how utility rate structures work, those capital expenses will eventually be passed on to ratepayers in the form of higher base rates. For major projects, access to power has officially replaced zoning as the number one bottleneck in site selection. If you're developing industrial real estate, multifamily housing, commercial projects, securing that electrical interconnection capacity early in the process is paramount. Investors who understand this are already adapting. We're seeing a major rise in on-site generation, in microgrids and commercial solar plus storage setups, and private power purchase agreements designed to insulate projects from delays in the grid and fluctuating rates. Power availability is not just a utility connection, it's a core asset valuation metric. So as you plan your investments for the coming year, over the next 5 years, make sure you're underwriting higher utility costs and verifying power capacity well before you drop a non-refundable earnest money deposit on a piece of land. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.